an interesting topic on small caps. Okay, the question is, after a very good run this quarter, should we lock in the gains? Should we book profits? Should we exit, or should we let them run? Right? So, at a time like this, these questions come in, and it is important because if you end up exiting too early, right? So then you may regret it. And I'll give you an example, right? If you see uh, the period from 2003, of the if you look at the Sensex, started moving from almost like 3,000 of the Sensex, then moved on to 3,500. Now, one may have felt that okay, at 7,500 or 8,000, it is more than doubled, so you should get out. Then it crossed 10,000. Again, you would have felt that, this is something that you should get out of. It went and hit 15,000. Okay, again, you would have felt it that way. And now it was maybe five times up. Okay, and it ended up going all the way, crossing 20,000 as well. Okay, so the point is, just imagine, okay, if you had locked in some bit of the returns and said, okay, let me exit, then it is something that one would really, really have regretted there. At the same time, you may find that the opposite example, wherein in 2008, if you missed getting out, say closer to 10,000 of the index, okay, then the 20,000 of the index, then it fell all the way below 10,000, right? So, and this is all of the Sensex, right? So today the Nifty is like the Sensex, and that also tells us how the long term markets give you a compounding. Okay, so the point that I'm making is that uh, it's important that you don't get out too early or you don't get out too late. Yeah. So broadly, what I plan to cover today, understanding the dilemma, uh, the case to lock in gains, why should you lock in the gains? Why should you let it run? Okay, there are reasons for both, and what history teaches us, and finally, what's the framework that we can make a decision. Right? I saw a couple of hands being raised, so uh, if let's say there's some issue with the volume or something, please let us know. But otherwise, questions, if you don't mind, we will take it at the end. Yeah. So coming to the first part, which is about understanding the dilemma. Okay. I think so. When you look at it, I wanted to start off from the absolute basics. Okay, what do you define a small cap? And this is important today because of the way I think SEBI has defined it recently. Okay, the large caps basically are the company which are ranked in descending order by market cap. Okay, first to the hundredth. Uh, so the what I mean descending order is the biggest will be number one, right? And the hundredth biggest will be number 100. 101 to 250 is basically mid caps, and the rest beyond small caps is a big number. Okay, which is beyond 251st company or beyond. Okay, are all small caps. Okay, so that's a very, very big number that you have there. And so if and this is the point that we are at, right? So if you see from March, small caps moved up 31%. Okay, whereas if you looked at the Sensex, okay, that has gone up only 7%. Okay, and that's the whole point. That's the whole question why we're trying to answer today. Should we book profits and exit, or should we let it run? Right. I normally like to start off with and also get a feel from all of you as to what is the mood out there. So I would like to run a poll here, and the question is, where do you see small cap stocks 12 months from now? Okay, and Do you think it'll grow more than 15%? Do you think it'll fall more than 10%? Okay, or you think it'll be range bound or moderate returns? Okay, I'm saying up to 15% is moderate the way I've defined it here. Okay, because one is I mean, for small caps, one would think that it shouldn't be the 10%. May not be moderate enough. Okay, so yeah, so we'll give maybe a few seconds for everybody to sort of poll in. Yeah, so this is interesting. So everybody is bullish on small caps, actually, which is almost like I'll just share that. Yeah, 62% are believe that it will grow more than 15%, and not too many bears out here, but 14% feel that it will fall more than 10%, and range bound to moderate returns. Okay, I think we have about 24%. So, so broadly, I think the mood is bullish towards small caps the way I look at it. Okay, so let's go through the presentation. So, I was just saying that, below, I mean, 251 and smaller, right, are all small caps. And the point to keep in mind is this is a universe, and which is why we cannot ignore it. It's a universe that almost like, you have a lot of companies which are listed as small caps, which are even above 1,500 crores, right? There'll be further number of companies which will be below 1,500 crores. But even if I look at, companies which are above 1,500 crores, almost like 1,061 of them. And the other reason why you would look at small caps is the large and the mid cap segments do not cover all the sectors that you may want to look at. Right? Okay, so if you find there's certain sectors with a niche, okay, then small caps may be a better place to do. And you may also find that certain upcoming sectors, etc., may be within the small cap universe, and that is why you cannot just ignore small caps out there. So, which is why it makes sense to have it within your portfolio. Okay. Now, let's look at it from the side of should we book profits? Okay. Okay, which is basically should we take money out and should we lock in our returns? Okay, uh, so if you look at it and well, again go by data as usual. Okay, so small caps typically fall harder when markets turn down. Okay, so you will find that you know uh, like in 2020 COVID crash, right? Nifty fell 38% to the bottom. Okay, mid cap index also interestingly fell the same, but small caps fell 45%, right? So and on the other hand, if you look at it, what fell more than 40%, you'll find that it's very, very skewed towards, the 65% small cap fell more than, 65%. Obviously, that's also likely there because, the small cap index fell more, right? So, but the point is, um, you know, it can be volatile, right? So 40% is not a small number. So which basically means if you had 100 rupees and the stock was 100 rupees, then it's fallen down to 60, right? Or less than 60 because the important thing to say that small caps when they fall can fall hard. Okay, small caps can go really overvalued. Okay, and you may find that just looking at a few ways of looking at it, say percentage small caps at a premium, okay, to their sort of 10-year average valuation. Okay, so you'll find, interestingly, we are not too bad right now. Okay, so if you look at from some of these measures, only 28% of small caps are at a premium. Okay, versus you would have found that in 2019 or which was even a little not too crazy as 2016, right? 2016 was like 57%, and September 24, okay, 64% of small caps were at premium. Okay, so So that's the point that when making from September 24 to now, okay, you'll find that valuations just from this metric has come down substantially in small caps. Okay, but the point we are making is you could find periods like 2024 where they can really go overvalued. Okay. Similarly, if you look at the opposite side, it's obvious that it will probably be similar that small caps, at a discount will be at a low, right? When markets are at a peak. So that's what numbers also showing there. So it's interestingly right now again, almost like 50% of companies, small cap companies are at a discount to their long-term valuations. Okay. Uh, Now coming back to uh, the other reason why small caps really are difficult, okay, is because the volumes, okay, and liquidity basically thins out. So what actually creates this bigger fall is that when you want to sell, right, you don't have buyers, okay, and liquidity is poor. So many times it may not be about the company performance. In the end, I really want to sell right now, and I may sell it for various reasons, and you find that the liquidity is very poor. Okay, so so the point to keep in mind is that uh, especially in difficult times, okay, small caps can be difficult to sell as well, which is why we say that, when you look at small caps, then you have to look at a much longer tenure. If tenure is not on your side, then, it may not be a good idea for you to invest in small caps. The other point is, it's theoretically it's very easy, right, to say, okay, portfolio is down, right? But actually, the hardest risk to manage is your own reaction. Okay. And it's basically because there are two emotions that come in, right? One is fear and one is greed. Okay. And when these emotions come in, it becomes very difficult for us, and it creates a lot of stress for us. Okay. Because theoretically, many times clients have come back and said, "Ha, Anil, I can take risk." Okay, but when market actually falls, is then they suddenly come back and say, "Oh, why is it down?" Or when will it recover and stuff like that. Okay, is you really feel it, when it is down, because what happens at that time also is the news flow, right? The news flow at the time when things are down will all be negative, right? Uh, March to the current, point, if you see, had a very good return, right? But if anybody, if I went to any client in March and told them, please invest, okay, they would have felt very uncomfortable, right? Because the war was there, okay, and things were so uncertain. Okay, the rupee was going crazy, okay, and there were a whole lot of things, which were happening. So, so from that standpoint, it'll always be the case. In fact, it's an interesting that I tell clients is, you know, the point when you're most uncomfortable is probably the best time, unfortunately. Okay. So 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 what is one thing that we can do is if we are able to think of it that way, if you're able to train our mind. Okay, so the way I've trained my mind is when markets are down, I say, wow, okay, great. Okay, at one point, should I start investing? I start searching for points to start investing, right? Because when it is down is when you actually get the best return. Whereas when markets are very high, then I'm always looking the opposite and saying, oh, you know what? Uh, how do I start taking out money? Okay, of course, like the point we are discussing today, the point that you take out money also is important. Too early, you miss out a big part of the move, and too late, it is disaster for one. Right. So that is the whole thing. So one point that you know is that if we are able to, and if we've gone through this cycle and we've seen it again and again, can we train our mind to say, okay, you know what, it is down, it's a good time. Can I put in for the money, right? And if I just follow the discipline, then it can be good for us. Otherwise, what does it do is it creates a lot of stress for us. Okay, so more than anything else, investing is one, but if investing creates stress, then what's the use of it, right? So that's something that is important for us to sort of look at. Yeah. The case to let them run, right, is why should you hold on, right? And this is a, I think, very powerful chart. If you look at the average rally from the bottom is 221%. Okay, so it is not small. Okay, and if you go back and see, December 24 was a relatively shorter run, or a smaller run, and that was 2.5x, which means the index went up 2.5 times. And this chart is only of the BSE small cap index. Okay, so if you look at in 22, it was 3.5 times is the rally. Okay, in 2018, it was 3.9 times. Right, if you again went to 2010, again 3.9. And if you go to the prior period from 2003 to 2008, there were multiple rallies. If you put all of them together, that would have possibly been the larger rally of all of these, right? So the point that one is making is that the returns are, the quantum of returns are not necessarily small. They are basically 221% is what you see as the average gain from the bottom. But on the downside, right, the crazy statistic there also is the average decline from the peak is 37%. Okay. Now keep in mind that 37% from the high is much larger than when you look at from the bottom, thing. So let me give you an example. Okay. So if a stock, has moved at 100%, let's take round figure, it's 100, it's moved to 200, right? 30% fall from 200 is 60, right? So it comes back to 140. Okay, so that is the impact that you see, when you see it from the fall. So that's something that we keep in mind. And the other thing is that why should you hold on? Okay, small cap valuations we spoke of in different ways, right? We spoke of another way to look at it. Okay, small cap valuations are not below their long term averages, and that also, sometimes is one of the best ways to look at in the long term. If your valuations are below long term averages, it's a point to buy. If it's higher, and of course it should be higher by a slightly larger extent, then it's also a point to sell. Okay, so it goes both ways. The other point is,
Just a minute. Screen is complete. Your screen is not visible. I mean, your face. Can you please turn off and on the cam? You're not visible.
I stopped my sharing as well, so I'm just
Yeah.
resharing.
Yes, sir. Now you can reshare. You are visible now.
Yeah, thank you. So yeah, so the point is, today the other reason why you should continue to be investors. 62% of small caps are below the 5-year averages. So if we look at 10-year averages also, so in both cases, they are around 60-65% of the time, right? You find that small caps are below their long-term averages. So this is another reason why, so basically they're at a discount, right? So this, it means that this is not a time that you should be selling. Okay. The other, I think, which is a very strong reason also not to sell, is the earnings, or what we call the profit after tax, right? Earnings growth means profit after tax growth. Okay, so uh, so if you look at here, there's a period where small caps did not do well, and that coincided with earnings growth being down. Okay, so sometimes what happens is markets actually are leading indicators. Okay, so you may find that, or they may also coincide at times, but you later on realize, okay, why the market fell. And one of that was, and the one basically in green, right, is the pattern growth for the small caps, right? So that is the point, that also why the small cap index was volatile and actually down. Okay, but since the second quarter of FY26, okay, actually small cap growth came back. Okay, and that was one of our reasons also, actually, we had given out a call and also did a webinar at some point around that to say, this is a good time to sort of actually invest in small caps. Okay, so that is something which we keep in mind, that earnings growth, if it is good, gives us also comfort that small caps are, will continue to do well. Of course, the last quarter had some impacts of the war. Okay, so one needs to continue to watch it carefully, and you know view if that changes. Okay, so that's something to keep in mind. But what does history teach us? So one is, okay, we've seen reasons why we should exit, we've seen reasons why we should invest. Okay, but what does history teach us? Okay, and I always believe that history rhymes, and in markets especially, that has been one way for us to be able to call out, certain turning points, and so the averages, if you look at it, and we already spoke of it, is the rally from the bottom is large, and it is 221%. Okay, which means the average rally is 221%. Okay, and what we also captured there is, after a decline, right? What is it that we see as recovery? How many times it recovered by? Right? So, and we captured that in graphical, and here it is, in a tabular form. But the point is, after a fall, you see a huge rally out there. And the second, so one is in terms of quantum. So we're saying that, okay, we've seen 31%, it's still not even crossed 200%, right? Which is when the average is 220. That's one point. The second point is, what is the time cycle, right? So basically, if you go back and look at the time cycle, okay, typically, small caps rebound between 22 to 47 months. Okay, and but the average will be somewhere around 24 to 30 months. Okay, so is which you can see from the table also. We'll have some which have done within 12 months, and you have something which has done even 47 weeks, right? So both, if you leave them out, okay, broadly it is coming something like 22 uh, you know 24 months is what I can see here. 19 to or the 15 to 24 months is how quick, or what is the time period of the rally. So that also brings us to the point that, okay, which is an average, say, of 24 months is where we see a rally. In that 24 months, you see 221%. Okay, so on an average, so that is the thing. So one is we're talking about time, and we're talking about percentage as well. Okay, and we're just giving, of course, this is not a full rally, and it's not completed its course, but even just give you a sense of, you know, uh, September 24, right? And the current one, and to give you context to that, okay, the Nifty fell 16%, from the peak of 24 to its bottom. Okay, and if you see on the other hand, small cap Nifty small cap 250 fell 26%. Okay, to its bottom. So what's interesting is, the Nifty fell, sorry, the small cap index fell 10% more, but if you see the recovery, right, the Nifty recovered 10%, but small caps recovered 31%, right? So the small cap index has now delivered a positive return from, while, if you see the from the bottom, basically, okay, the Nifty has not done much. Okay, now keep in mind, you may come back and say, okay, has it actually and gone past? Not necessarily so. Why is that? I spoke to you that the fall from the peak, right, and the recovery from the bottom, uh, the fall from the peak is more severe because it's already moved up and falling from there, right? So that is the thing to keep in mind. But the point one is making is, if you just look at returns from these periods of time, okay, the recovery has been very strong. And the other thing to keep in mind is that, over the long term, uh, you'll find that earnings growth and stock price growth converge. Okay, so we believe that earnings growth is one of the best indicator. Okay, And at times like these, you'll find that the price trend, okay, has been 12.8%, and Nifty 500 has been something 11.5. Now, if you look at for even longer periods, typically they converge. Okay, so that is the point that we sort of keep in mind. And the green bar is basically the EPS, or the earnings per share growth. And what this tells us, interestingly, is that the earnings per share growth has been higher than the Nifty 500 growth, which also is it's not unexpected, because that gap has increased after March 24, because the markets have been relatively weaker, or they're flatter, right? So from that standpoint, while earnings continue to grow, okay, you find that uh, the the index has not necessarily moved as much. What this also tells us is there is a larger rally, and there's a longer upside that is left. Okay. So, what is the framework for a decision now? Coming back, okay, we looked at now even historical data and stuff like that. How is it that we can decide, right? So, so the whole point of how is it that you can decide. Okay, for the first point, we would like to say ride the wave, don't exit too early. Okay, that is a point that I've been sort of repeatedly saying. Okay, because for many investors, we may have lived through the downside, which is longer. You don't get out of it so quickly. Okay, so you should also enjoy the upside. Is one of the point, and uh, typically, like we saw that a small cap move is about 24 months. Okay, and and broadly the lower range of it is say around 15 months. At least after 15 months or so is where one can start being watchful a little bit more. The second point one is talking is about prioritizing quality. Okay. Now, while you're investing, okay, let's say if you're investing in mutual funds, look at funds which are, having a better risk measures apart from maybe return measures. Okay. While you're looking at stocks yourself, then look at various parameters, see how, the earnings growth of the companies are. Okay. And because what may happen many times is momentum may do well and run up. Okay. The issue that you have is if you're not an active investor and you're not able to get out very, very actively, then at the end of it, you may actually just see a fall, which is higher. Okay. So, so that is something which, and repeatedly we've seen that. Okay. So, let's say, let me give an example of at times, you have a wave that moves up quickly. And we had a wave that, PSU stocks did very well in the last cycle, right? So when PSU stocks did well, first the ones with good quality went up, okay? But over a period, you found that the ones with poorer quality, ended up also going up, okay? Because it just became in fashion. Right? People are saying, okay, which is a PSU stock, okay? And it went up, right? What one saw in the long term. So if you see that as of now, there's a huge difference between quality PSU stocks and other stocks. Okay, so once they didn't have earning growth, some of them really went up to very high PE ratios, etc. And they were the ones which came crashing down much more. Okay, so the quality ones like if you saw VEL, REC, etc., would have been a little better. Okay, of course, ones like REC and all also went up, and VL did go up sharply. So when the corrections happen, they can also be significant. But the point I'm making is, there were a lot of really, poor earnings growth, PSUs, which also ran up in that period of time. The other point is to, one is to say that okay, look at quality, look at companies with better balance sheets and profit growth, etc. The other is about okay, how do I look at how is the environment, right? Uh, so if you are again looking to invest in say small caps, especially studying the growth drivers become very important, right? So for us, some of the sectors that we had identified as like hospitals, even not within healthcare, hospitals is what we have like. Okay, and why we're saying, yeah, the penetration is very low and that should actually grow, right? So that is something. Well, similarly, like that, manufacturing and also, triggered by China plus one, etc., is something that we have liked. Okay, and within manufacturing also, we sometimes have been very niche and the type of companies that we've looked at. We've looked at, say, electronic manufacturing services, okay, which you have a lot of companies who, put together, assemble your cell phone and various other, electronic items. So that is something which are things that we like. So capital markets, our own industry, which is wealth management and asset management, is something that we believe will do well for long term. So I'm just saying, I'm just giving the thing as examples, right? So and renewable energy, also I don't think that requires me to explain, right? Which is very very critical. Also with oil prices high, there's a big push towards renewable energy, and the rupee also has depreciated, so there will be a big thrust towards renewable energy. And this is the point that I'm making, that if you're able to identify some of these trends, right, then they are good things to be able to leverage on and take advantage of. Okay, so and because what that will do is it'll help make it more successful for you. Okay, but at the same time, say if you're a mutual fund investor, sometimes the temptation is, say, to go into sectors and stuff like that, all be very exposed to only small caps, only mid caps, only large caps. Those are things where one believes that is a little different from when you are, investing at a stock level. When you're investing at overall, you look at your overall portfolio, then you have to look at certain metrics and a discipline for yourself, as to how you cap your, risk, etc., at various levels. Okay. The other point that to keep in mind, and that's very very critical, is that you also the approach that you should have in mind is to be able to book profits when things are, the cycle has sort of come through, right? So it is very important. So I'm not saying that you shouldn't be doing profit booking, and I'm just saying that right away when and the point at which you do profit booking becomes important for you. Okay, so when do we typically do it as a stock level? We do it at a stock level when we think that the stock has done ahead of its fundamentals, because many times even now at the global level, you're seeing volatility on some of the AI chip makers, for example, and suddenly, Nvidia has lost its number one market cap position to Apple, right? So those are things that happen, and when things move up very fast and for a long period of time, you'll find corrections. Of course, one still believes that maybe unless there's other reasons that trigger the AI cycle, I think there's some bit of steam left. Okay, but definitely, there is every cycle comes to an end, and definitely, sectors like AI globally also are ones to be watched carefully, and that's why profits, right? And so many times, again, I'll give an example of clients who hold stock options, right? So you do it, you diversify for also lowering your risk. Okay, that's number one. Most of the time, if you are you are in the same industry, okay, so it's good to be diversified away as well, because your job may be, depend on how the industry does, right? So if your company is under pressure, you're probably likely that over a period of time, even jobs in the company will be under pressure, right? So many times, there's always this temptation that, okay, it's already gone up three times, it's already gone up four times, and okay, I think it will go up more. Okay, so that is something which I think one should be very often be a little careful and uh, you know accordingly look to book profits. And of course, coming back to small caps specifically, you would see that very very important to book profit, because The average fall from the peak is also 37%. Okay, and like I explained to you, the impact of the fall from the peak is much more than a rise from the bottom. Okay, so in terms of percentage terms, so which is why it's important to book profits periodically on small caps. And just to summarize, okay, I wanted to finish my presentation so that I can give sufficient time for Q&A, okay, and to engage with all of you. So just summarizing what one is wanting to say, yes, uh, small caps are run up, but it is uh, it's not completed a cycle is what our view is. That doesn't mean that there's not going to be volatility there. If you go back and see relative performance between, say, small caps and large caps, there are periods then when it runs very fast, then it may pause, and large caps may move at certain points of time, or you know, uh, small caps may correct a bit, okay, in a smaller cycle. But we think that this, there may be volatility, but there we don't think it is over. So, which is why I think it's too early to exit right now. It's good to probably ride a little bit more of it, both a combination of maybe time, which is say 15 months, as well as percentage. You know, not necessarily wait for 221%, but maybe when it's at 1.5x itself, okay, to start looking at, or maybe 2x to start looking at things again. So, the other point is about prioritize quality. Okay, be disciplined in what you do. If you're, especially when in small caps, sometimes there are periods when people overextend. Okay, but how do you look at quality? There are risk metrics. If it's a mutual fund, the risk metrics that you can look at. Uh, if you are looking at stock portfolio, then there are today certain portals where it'll even rate your stocks, right? So you can utilize some of these tools to be able to understand the quality of your portfolio. But to put simply, if you are buying stocks, okay, how do you look at companies with strong balance sheets? How do you look at companies with good earnings growth, which is profit after tax growth? Okay, and companies say which are able to maintain their margins, etc., are the ones which are basically of high quality. Okay, the other one is about look at and study what are some of the growth drivers, what are the sectors which are going to do well, okay, what are the themes that, let's say, the government is supporting or the market is, moving towards, and then accordingly reposition, especially if you're, this becomes important if you are yourself, investing in small cap stocks, okay, because the difference between, especially on the small cap side, the difference in performance can be very large, okay. And the last point is to manage risk actively. So, so I'm just saying that it may not be time to exit right now. We aware that there could be volatility because of a bit of a run up. Okay, but continue to maybe stay invested, and as time goes by, try and improve the quality of your funds or your portfolio. Okay, and finally, of course, it's important to manage risk actively. Yeah, so that's broadly it from my side. Okay.